All right, ladies and gentlemen, welcome to the stream with MacroAce with your host Tony. I'm also the head analyst at FinancialJuice. PPI. So we had good data for CPI yesterday. Let's see how PPI reacts, or how the markets react to PPI. It might be muted, or it might be as strong as, might be even stronger. Maybe not as strong as the reaction to CPI, or it might be. But let's go through the expectations, what the release is all about, and then we'll go through what are the targets, what is the deviations that we're looking for the PPI data. But thank you very much for joining me so far. So let's go through this. PPI. So it measures the changes in prices that manufacturers and wholesalers pay for goods during various stages of production. So you have your intermediate goods, you have your raw materials, and then you have your finished goods. Okay. So your raw materials being that of you more or less be looking at mining companies getting the raw materials from the ground, maybe the farmers with the grain. Then you have your intermediate goods, of course. Then maybe that's turned into, if that grain is then turned into barley, it will turn into alcohol or bread, and then they have the finished good, whatever that might be, and then that's sold off by the retailer or the other service that's providing it to other businesses. Okay, so there are various different stages of production just to be aware of. So how does it affect the markets then? So PPI, in the past, it generally hasn't had that much of a reaction before the Fed's hiking cycle. During the Fed's hiking cycle, when everyone has been laser focused on how strong is inflation and when will the Fed pull back, or when will the Federal Reserve slow down, all inflation data has had a boost in importance, and that's the reason why that's happened is because of the reactions that the markets have displayed from the different inflation data. So with the PPI data in this current circumstance, whenever you see PPI higher than expected, that tends to favor a stronger dollar, or you see a stronger dollar reaction towards you see bullish reaction, because that in turn leads to the expectation that the Federal Reserve is going to hike rates for longer, or maybe tighter monetary policy a bit more than economists or traders would expect, or it feeds into the expectation that that's what the central bank might do in the future. And that's what happens to the dollar. The stock market, same thing. Obviously, the inverse relationship, should I say, is that when you do see inflation or PPI data rising sharply within a month, then that leads to stocks taking a hit. Again, for the same reason as to do with dollar, the expectation of the Fed being tighter, more aggressive with their monetary policy. Then for the bond market, a higher rate of PPI data or inflation can lead to high yields. Same reason as the first two. And then, of course, you have the bond prices, that if you do see higher than expected data, then you see that the bond prices, higher than expected data leads to bond prices going lower and yields going higher. And then vice versa. Okay, so if you do get data that is worse than expected, then for the dollar, so Elia Hassan says, what happens when PPI comes out below the forecast? Yeah, so whatever happens, whatever you can see here, it basically is the opposite of what we have here. Okay, so if data is weaker than expected from PPI, then you expect a bearish reaction from the dollar, a bullish reaction from the S&P or the stock market. And then for bond yields, you'd expect bond yields to go down and bond prices to go higher, depending on how big the deviation is. And we'll go through that in a little bit. But that's how the markets react usually with PPI data. Now, where is the economy at the moment? So, of course, we had a very important inflation read yesterday. If we're looking at employment costs, it was at 1.2% compared to it was at 1% compared to 1.2%. CPI year on year, a whole point down, okay, compared to the prior. So 5% compared to 6%. So a big old jump compared to what we've seen in the past, where you might have seen about a 0.5 or 0.6% deviation between the prior and the actual figure. or a decline. And this is probably, I think this has been the biggest jump so far with CPI within this current tightening cycle we've seen with the Federal Reserve. So that's quite key to understand. Core CPI ticked up higher though to 5.6% compared to 5.5%. So that in itself led to traders still pricing in a 25 basis point hike for May, but less of the chance of that happening. So I think it went from 73% to about 60% chance or expectation. 60% chance of a 25 basis point hike happening at the May meeting. So still expecting a 25 basis point hike at the meeting, but kind of weakened a little bit because of how the headline data came in much smaller than the previous figure. ISM manufacturing prices paid was at 49.2 compared to 51.3. ISM services prices paid 59.5 versus 65.6. Productivity 1.7% compared to 3%. Import prices minus 0.1% compared to minus 0.2. Export prices 0.2% compared to minus 0.8. PPI the last time around it was at 4.6% compared to the prior of 5.7%. So there's also been a very good jump down in inflation figures or in PPI figures that we've seen on that side. And the core PPI data was also seen a point down, a percent down as well. Industrial production month to month 0% unchanged. Manufacturing output 0.1% compared to 1%. So if the data has been seeing a tick down by quite a bit recently, then you're expecting the direction to stay the same, with the figures continuing to move towards the downside. Of course, the only question is, does the deviation become bigger between the previous and the actual figure, or do you still see a decline but the deviation isn't as big as it was, i.e. the slowdown is happening, but the slowdown is also slowing down, if that makes sense, right? Your inflation isn't slowing down as much as it has been, but it's still good. It's still on a path towards going down. All right, if we carry on then. So what is of course talking about what are the other reasons why PPI can be a very good report to look at? It can be an indicator for CPI. So as said, we have crude goods, intermediate goods, and finished goods or furnished goods. Okay, so all these, the key point is when you're looking at the report is what are the finished goods prices, okay, and also the services as well. That's where those prices are more than likely going to be passed on to the consumers. So if you do start to see, let's say if prices do fall at the finished goods stage or finished services stage or the final stage of services, right? That's going to be very important to understand that, okay, if the CPI more or less further down the line is going to be weaker in the future. Doesn't mean, so whenever you do get PPI data that is weak for 1 month, it doesn't mean the CPI report is going to replicate the same move as the PPI report does, or the magnitude of the report that the PPI report does. All it means, really what you're looking for is consistent downside movement in PPI to say, yeah, the more than likely costs and prices, a cost for businesses and then prices for consumers are going to head further down, which is of course what the Federal Reserve wants to do. And then once they get nice and cushy to their 2% target, then that's all good. But that's one thing to bear in mind as well. And the other key thing is that food and energy makes up about 40% of the finished PPI report. Previous reports are goods over 80% of the February decline in the index for final demand goods can be attributed to a 36.1% drop in the price for chicken eggs. Then you have the index for residential natural gas, fresh and dry vegetables, diesel fuel, home heating oil, and primary basic organic chemicals also fell as well. So don't forget, if you're enjoying this content so far, don't forget to share it with your fellow friends and traders if you find this information useful. Don't forget to subscribe to the channel, like the video as well, get the word out there. We're kind of more or less halfway done with our PPI prep. But yes, do not forget to do that. And yeah, Andy will go through the FMC headlines as well. All right. So services. So leading the February decline, margins for final demand trade services fell 0.8%. Prices for final demand transportation and warehousing services decreased 1.1%. Then the sentiment and view and for investment bank views and markets. So 2024 woes. So this is going to be quite interesting for what manufacturers are feeling at the moment. So according to a different, particularly construction businesses within Dallas, within Dallas, Texas. So they say that tightening of venture capitals and banks leads to a drive for investment and loans. As what Dallas Fed showed, a sizable share of banks in region reporting stricter credit standards. So there's a lot of talk between these manufacturers and producers, construction companies, that they know what to expect for 2023. They've kind of got their expectations for their profits and what that's going to look like this year. 2024, though, is a bit of a mystery. Is what a lot of those businesses have been saying in Dallas. Now, of course, there may be some in other areas of the US, but that's what's been kind of brought up from doing the research so far. So that's going to be quite interesting. That 2023 might be an okay year where people will know what's going to happen, but when the rates really start to hit home and really take effect, then that's where businesses are a bit more unsure about their future. So that's another thing to bear in mind as well. Although PPI, if it does continue to go down, it might go down by quite a significant amount if businesses are seeing a shortfall in their orders, if there's not enough production that's happening, maybe not enough services are being used, and not enough transportation of goods between different businesses, and things just fall off the cliff. So that's one thing to be aware of, is that, of course, we're mainly focusing on the short-term reaction, okay? For day traders, what does PPI do within the markets? But then you have the overall picture of what does that mean for the rest of, let's say, 2023 and a bit of 2024 for the markets, and what sentiment does that create then for the rest of the year in 2024? The C word. So, credit crunch, or the C words. So, chief economist, Associated Builders, saying that credit is beginning to tighten. So that's, again, same thing, that these construction companies are seeing tightening credit conditions, something that the Fed is expecting, but it depends on how strong that then becomes. And does that become even stronger where credit conditions really hit hard and hit home, and you don't have any, and then you have construction falls off again, as I said in the first point, things start to fall off, and then you have a productivity that also falls off in due to that happening. So April 10th, we had Citi seeing oil falling despite OPEC efforts to prop near $80. And they said that economic slowdowns in the West are no longer awaited recovery in China's economy. So Citi, so this is going to be quite key for the future and for the next month's CPI report too. Of course, we didn't get the effect of the OPEC cuts in the report that we had yesterday for CPI, but also for the next report for PPI too. That's going to be quite key as to seeing how much does oil hold up, and whether or not that, let's say that about a $5 jump that we had before the before OPEC decided to make that announcement to around $81. How much effect will that have on supplies and goods and services that are being provided? So let's kind of carry on as well. Fed and other government views. So April 3rd, Yellen said that OPEC Plus does not appear to have an impact on appropriate level of Western price cap on Russian crude oil, which is currently priced at $60 a barrel. Other than that, there isn't really that much else. It's more it's kind of waiting for the impact to see what OPEC does to businesses. Okay. And then if the figure is much weaker than expected today. So not really too much sentiment surrounding the PPI data as there was compared to the CPI. So the triggers then for the economic release. So the month-on-month seeing a high expectation, according to economists, of spot 3%, and with a low estimate of minus 0.3%. Year-on-year with a high estimate of 3.6% with a low of 0%. So you can see how wide the move is, and we'll go through the deviation as to why that might be. If we carry on, so a core month-on-month with a high estimate of spot 4% and a low of 0%, and core year-on-year with a high of 4% with a low of spot 2%. Okay, so economist estimates, so Wells Fargo sees 3% for the year-on-year, Citi as well. JP Morgan sees a slightly lower figure, 2.9%, the average median being 3%. Core year-on-year, you have Wells Fargo and JP Morgan seeing 3.5% and Citi seeing 3.4%. So those figures are going to be quite key to keep an eye out for, particularly if the core data, especially the core data. If the core data yesterday, although it was slightly higher than the previous figure, it came in line with expectations compared to the forecast, and it didn't stop the market from seeing a bullish reaction in the stock market. If for whatever reason you do see the core data is much higher than the forecast, that would then be a worrying sign. But if it's lower than the previous figure, then it kind of balances itself out. So you might get a bit more of a mixed reaction. Okay, so this is the previous report that we had seen from PPI. Okay, so this is about 10 seconds before the previous release. So back on January the 8th. Oops, let's kind of go a little bit more. That was the previous reaction there. So can go, here we go. Feb 16th. Sorry, apologies. You'll bring it back. Believed I had this video set. Apologies, I did not. Okay, so there we go. So the data comes out, and we can see how the market reacts. There we go. So 6%, which was higher than the expected 5.4%. You'd seen the dollar move towards the upside. Stock market has seen a move towards the downside. All the data was higher than expected, okay, by a decent margin on the core data and the headline, and then the year-on-year data for core year-on-year and the normal year-on-year. So we kind of skip ahead a little bit more. We can see how the reaction didn't really, it wasn't really as strong, let's say, compared to what we'd seen in the past for PPI data, where you'd seen a continuation of one move. So it was more of a quick move, played around for a little bit. Keep going. Okay. But you can still see that after, even though, after about, it's probably about 10 minutes there, that the S&P was still lower than where it was post the trade. Dollar was still trying to hold up as well there, the dollar yen, but again, it wasn't a clear shoot up, and then it continues to hold its move. Just like CPI yesterday. CPI yesterday was pretty very good. Seeing the dollar take quite a big quite a big of a hit off of the back of that. So if we're looking at yesterday, the dollar yen had seen 73 pips down the back of a move. In the past, you would usually see the S&P have a huge move. It did have a big move, but it wasn't as big as it was in the past. So what that tells us is that if PPI data is better than expected, if PPI data comes in lower than expected, you'd expect a decent move, but not as big as a move as we have seen in the past. So yesterday, if I bring up PPI, so last time around when data was all lower than expected, okay, even with a 0.8 deviation on the PPI headline data, you'd seen 56 ticks towards the upside on the S&P. Excuse me, 50. Oh, I was showing the wrong date there again. That's my bad. Whoopsie. Let me grab the other video for that. Hold on. Sorry. Apologies. I need to look at March. Okay, so apologies again. I showed you guys the wrong video, so of a previous report. But if I just so from what we'd seen last time around, when data was lower than expected, you had seen a positive reaction from the S&P 500. So it was about 56 ticks was the upside, and then we had seen 44 ticks was the downside after about 10 minutes of trading. So I bring up the deviation here. This was the last market reaction. So of course, the markets were also focused on the fallout from Credit Suisse at the same time. So there's also that was also having an impact on the markets as well. So when data was, let's say, really good, or there was a good, decent move from PPI, or if it was non-farm payrolls, then you would have the markets that would react to the data, and then the market would go back to focusing on what the banking fallout was causing at that time. So you would see a risk off a reaction post the release. So here we can see, as said, there was 44 ticks was downside on the dollar yen, which was where we'd seen the biggest move occurring. There was 50 pips down, and after about 10 minutes of trading, it was down. It was kind of clawed back some of its earlier move, and it was down 26 pips. Okay, so that's what the market reaction was like then. So more or less what we're expecting to see is so even if the data is lower than expected, we could see a similar reaction. But I think now that the banking crisis has kind of gone out of focus, and you're not seeing, we're not getting any we haven't seen any banking headlines come through to cause any extra risk off sentiment, you could see more of a decent reaction from the PPI data. But remember, if we've seen on the headline figure itself a 0.8 deviation, and we get this sort of move again, that would be quite surprising. Again, as said, if there's been no risk of sentiment from the banking crisis. And you've already had a good CPI data yesterday as well. So if we're looking, I mean, ideally we'd want all the data to go in one direction, see a decent reaction. But again, last time it happened, Just want to be careful of any just mini whipsawing that occurs. But I think PPI would be the last sort of like the figure to kind of put the nail in the coffin for whether the Fed sticks with one more 25 base point hike, or continues or might decide to continue on with another rate hike post the May meeting. Okay, we have 1 minute left till the PPI data. Okay, we're looking at so all the bits of data need to be going in one direction. Okay, if we do see a bit of a mix, then expect more of a mixed reaction from the markets instead. All right, so we're looking at the dollar yen, got the S&P, and we got the bond prices. Okay, 10 seconds. Let's see what happens. So seeing a jump on the markets in the S&P, 2.7%, 2.7%, lower than the forecast of 3%. PPI month on month minus 0.5%, minus 0.5%, lower than the forecast of 0%. Core PPI year on year 3.4% as expected. Core PPI month on month minus 0.1%, minus 0.1%, lower than the forecast of 0.2%. Initial jobless claims also coming in lower than expected. Higher than forecast at 239k. Higher than the forecast of 235k. Continued jobless claims. You see 1.1810 million, 1.810 million. Higher. That's lower than the forecast of 1.835 million. So the S&P, okay, seeing a decent initial reaction. We'll kind of have a quick measurement of that now. See what we have. Okay, that's 54 ticks towards the upside. That's the same move that we had last time round. So if we're not seeing a very strong initial reaction from the S&P, we could get the same reaction as what we had last time round, where you just see an initial blip, and then the market kind of just reverses on itself. But that's not to say that although the data was more or less in favor of, the expectation for one more 25 at the Fed's May meeting, you're not really seeing the markets kind of take off with it. The reason being, it happened yesterday with CPI data, with the S&P flying. But as said, it wasn't as strong as yesterday. So S&P last time had 56 ticks was the upside. Today we see 54. On the initial move going to the wick of the candle. Dollar yen last time around has seen 50 pips down. Let's see what we've got here. Okay, so 39.5 pips towards the downside. Or around that. Okay, so again, not as strong as a reaction last time round with the PPI data. We'll also have a look at gold too. Yeah, that's 35 ticks towards the upside on 2-year bonds. On the bond price there. Last time around there was 45 ticks. Okay, so this market reaction, yeah, it's pretty dead now. I think. Okay, gold had a bit of fun. Hello, gold. What did you do? Let's try that. Okay, so that's what 85 ticks towards the upside on this initial move. Now, comparing it to last time, that's a bigger reaction. 63 ticks was what I'd seen last time round initially. And then after about 10 minutes of trading, it was up 33 ticks from the initial market reaction. Okay, so today's release, you had the initial reaction. That's kind of peeling looks to be, not as strongly sustained as it was last time round. Actually, last time around it wasn't that strong either. So more or less looks the same of what we had seen or similarly. All right. Yeah, I think just out of curiosity, I know Andy did bring up the FMC data. The FMC meeting minutes yesterday. So yeah, there's a bit of a mixed. So all Fed officials backed a 25 base point rate hike at the March FMC meeting minutes. And then several officials considered whether to pause at the March FMC. But again, it's not really. But they also did lower their view of rate peaks following the bank strain. So a bit choppy and a bit dicey for the markets to kind of take that in. But the other point being is that they saw indicators slower than expected progress in disinflation. So inflation wasn't falling as fast enough. But now, of course, we've had the CPI data yesterday and the PPI data today, seeing huge declines. That should more or less, the next FOMC statement that we get will probably just say, the Fed's job is done, and we can do one more 25 base point hike, and that's it. We don't have to do any more work. All right, so how the market's taken it. So again, as expected, dollar to see a decline if the data was weaker than expected, and the S&P to see an appreciation if it was weaker than expected. All right, so that is MacroAce for the week. Now, don't forget, although apologies for earlier on for showing you the wrong video of the market reaction. So FinancialJuice is where you get the live data for the economic releases. You also get the live news as well. Just kind of shut TICKSTRIKE off. So FinancialJuice is where you get live voice and text. Okay, if you've never come across a live voice and text service, maybe because it's something that the retail traders don't really have access to, or might have come across, or may not really have gone through too much. It's something that the big boys have access to. They are the ones who they have a big advantage. Of course, they'll be able to understand why the markets are moving in a certain way, what's causing the volatility, and in turn they can either capitalize on potential volatility or trade that's occurring, maybe adjust their positions or manage their trades, manage the risk that they have within the markets already. So that's why a live voice and text service is key. Key thing is, why the markets are moving in a certain direction. If there has been a fundamental bit of news that's occurred, maybe it is Fed's Powell that said something recently, or maybe there's been a political event or geopolitical event that's occurred, that's taken place, that's causing a risk-off sentiment, or maybe risk-on sentiment, depending on what it might be. But that's why people have, that's why the big boys have a live voice and text service, so they can keep abreast with what's going on and then manage their trades. So what we want to do is give you guys access to, of course, FinancialJuice is free to sign up to, okay, for the light version of Pro. So with the light version of Pro, of course there is a delay to the site, okay, and to the stream, but it's still quite useful if you've never really come across what a live voice and text service is. Just something to kind of get used to. Then when you're ready and you feel like you're comfortable with how the site works, then you can go to the Pro version of FinancialJuice, okay, and there should be a button that says Go Pro. As long as you have an account first, then you click on the button here and choose the subscription that you want. Once you've chosen subscription, paid for it, go back to the website, log in, log out and then log back in again, or the other way around, and that'll act as the verification process. So that link is there to sign up to FinancialJuice. That's a free, again, that's free. And then, of course, when you're ready, you can click on the GoPro button and GoPro. Getting comments through here already. Yeah, so I think the markets were, so I think if we did see higher than expected figures from the PPI data, that would have maybe rocked the market in maybe a not so positive way. You might have seen a bearish reaction from the S&P 500. But like I said, if the data comes in, it came in lower than expected, which is what the markets were looking to or happy about, then you don't see too much of a reaction happening. Yeah, so Scottish Stock says it has been weird because yesterday I feel it was good news and this should have a negative impact on inflation next month. Well, it might not have a negative impact on inflation next month. Like I said earlier on in the video, there's a bit of a time, let's say there's a bit of a gap between how quickly prices are passed on to consumers and other businesses, onto consumers, excuse me, before, because businesses won't just change their prices 1 month just like that on when more constantly change it. They like to keep it stable so consumers know, what they're paying for. It's not like you're going to go to, let's say, I don't know, your local shop, and the eggs they have today, they're $2, and then the next day they're $3.50. So they've got to try and, of course, they might decide it might have a very impact on inflation next month, but it depends on how quickly that happens. Yeah, Andy says, Scotch and Stock says, yeah, I just joined the Lifetimers. Yeah, awesome. Thank you very much. That is great to hear. Accelerator, I think that says thank you. Andy Bleeds says thank you for all these videos and FinancialJuice as well. Scotch and Stock says time to make money. Yeah, baby. All right, so that is FinancialJuice. Final bit is with MacroAce. So with the deviations, besides the old video that I showed you on the feed, it's a very old reaction. MacroAce, the deviations, that is always nice and up to date. So I send out an email every Sunday, completely free. It gives you a summary of what to expect for Asia, Europe, and the US session, and the summary of the weekend news, and then the deviations for the upcoming releases with the upcoming live streams as well. Okay, that is all in one place. It's very simple. It's not complicated. You don't have big paragraphs of text or lines or line graphs or bar charts. It's simple. It's supposed to be, because I explain more of the detail to you guys here in the live stream. So just so you can kind of manage your expectations, thinking, oh man, what the heck is this? What kind of stuff is this? Did somebody say why is gold spiking again? Yeah, I think it's so. Let's have a look at what if we're looking at how the dollar's reacting on the market. You can see that it's the expectation that the value of the dollar is going to go down, right? If more or less the hiking cycle has come to the end. So there might be another bit of news, which I can't see here. So more or less just off the back of the market reaction, the initial move that's occurring. So if we look at, actually, let's look at some of the other currency pairs. Let's see what we got. Okay. Yeah. Okay. Yeah, so gold is it's doing its thing. So gold is now becoming more valuable than the dollar. Okay, well, good luck with your position. Anyways, that is it from me from MacroAce. Next week, it's dead. There's nothing going on. So I will still give a summary of what to expect for the week ahead. session wise, but on that, there's going to be no other live streams as well. All right. Thank you, Horatio Lopez Siemens, trader, saying I am following you from Argentina since a couple of weeks, and I like FinancialJuice. I have a YouTube channel too, and I'm recommending them. Thank you very much for recommending us as well for us. All right, sayonara. Take care. Have a great weekend, and I will see you guys next time.